On April 23, 2026, Tokyo's trading floors erupted in a wave of excitement as the Nikkei surged past the historic 60,000 mark for the very first time. The atmosphere was electric, with traders cheering and congratulating each other, fully aware they were witnessing a milestone that had eluded Japan's markets for decades. The digital boards flashed 60,013.98, a new all-time high that instantly became a symbol of renewed optimism for Japan's economy. For many, this number represented not just a financial achievement, but a sign that Japan was finally shaking off the shadows of its long economic stagnation. Traders celebrated with high fives and applause, breaking through a psychological barrier that once seemed unreachable. The sense of accomplishment was palpable, as if the entire nation was taking a collective step forward into a new era of possibility. The news spread rapidly across the globe, with international headlines highlighting Japan's dramatic comeback. After years of being overshadowed by other markets, Japan was suddenly back in the financial spotlight, drawing attention from investors and analysts worldwide. But the euphoria was fleeting. As quickly as the excitement had built, uncertainty began to creep in. Traders' smiles faded as they watched the numbers begin to slip. Like a climber forced down by a sudden storm, the Nikkei's grip on 60,000 proved tenuous. Within hours the index began to tumble, erasing the morning's gains and sending shockwaves through the trading floor. By the end of the day the index had fallen sharply, closing at 59,140.23, deep in the red. The dramatic reversal was a sobering reminder of just how volatile and unpredictable the markets can be. The sudden downturn left investors stunned and confused, scrambling to understand what had triggered such a rapid change. Many were left asking, what just happened, and what does it mean for the future? This single trading day became a vivid window into the volatile forces shaping our interconnected world. It showed how quickly fortunes can change in today's global markets, and how local events can ripple across continents in seconds. Understanding this moment reveals not only the powerful trends and risks driving today's markets, but also the resilience and adaptability required to navigate them. The Nikkei's brief moment above 60,000 will be remembered as a symbol of both hope and caution for investors everywhere. To truly grasp the significance of the number 60,000, it's important to first understand what the Nikkei actually is, and why it matters so much, not just to Japan, but to the entire global financial community. The Nikkei 225 is Japan's premier stock index. It tracks the performance of 225 of the country's largest and most influential companies, spanning industries like technology, automotive, banking, and retail. These are the giants that shape Japan's economy and, by extension, impact markets around the world. The Nikkei isn't just a local indicator, it's a global barometer, closely watched by investors and analysts everywhere, right alongside the Dow Jones and S&P 500 in the United States. Movements in the Nikkei can send ripples through international markets, influencing decisions from Tokyo to New York and beyond. The Nikkei's daily ups and downs reflect the health and direction of the world's fourth largest economy. When the index rises, it signals optimism about Japan's future. When it falls, it can spark concern across the globe. Its previous all-time high was set back in 1989, at the peak of Japan's economic bubble, just before the country entered what became known as the Lost Decades, a long period of stagnation and deflation. Breaking that decades-old record and reaching the 60,000 mark is hugely symbolic. It's more than just a number, it represents renewed confidence in Japan's economy, and hints at a potential recovery after years of uncertainty. For investors, this milestone is a powerful psychological signal. It can attract new global capital, encourage more trading activity, and even inspire optimism among everyday people in Japan. But it's important to understand how the Nikkei works. Unlike some other indices, the Nikkei is price-weighted. This means that a handful of high-priced stocks have an outsized influence, and their movements can sway the entire index, even if most companies aren't seeing big changes. So, the journey to 60,000 wasn't about all 225 companies rising together in perfect harmony. Instead, it was a select group of tech giants, companies at the forefront of innovation and growth, that pulled the average up. This is a crucial detail for anyone trying to understand what's really happening beneath the surface of the Nikkei's record-breaking run. In the next chapter, we'll dig deeper into the story behind these powerhouse companies and how they shape this historic moment. The force behind the Nikkei's surge? Technology, specifically the AI boom. Major players like SoftBank, Advantest, and Tokyo Electron soared as investors bet big on AI's future. These companies, at the heart of the semiconductor and AI ecosystem, drove the index higher. This mirrors a global trend, a few tech giants fueling most market gains. The promise of AI as a transformative technology created a self-reinforcing cycle of optimism and speculation. The Nikkei's record was a vote of confidence in Japan's tech champions, but also a sign of a market driven by hype. When optimism runs this hot, bubbles can form, and burst, fast. The Nikkei's record wasn't just about tech, it was also about geopolitics. On that morning, news broke of a possible US-Iran ceasefire extension, easing fears of a wider Middle East conflict. Investors worldwide breathed a sigh of relief, and markets rallied. For Japan, less risk of war meant lower energy prices and more stability. This risk-on mood gave the Nikkei an extra push over 60,000, but the optimism was fragile. The ceasefire news was unconfirmed and quickly began to unravel. Modern markets react instantly to headlines, often before the facts are clear. As doubts grew, the market's mood shifted just as quickly. The US-Iran news was the wind in the Nikkei's sails, but it didn't last. The Nikkei summit was brief because the news that fueled it fell apart almost as quickly as it had arrived. For a moment, investors believed that a breakthrough in global tensions would usher in a new era of stability and growth, but that hope proved fleeting. Hopes for a US-Iran truce faded as officials from both sides denied any agreement, reigniting fears of conflict in a region critical to the world's energy supply. The headlines that had sparked optimism were quickly replaced by uncertainty and anxiety. Oil prices spiked almost overnight, sending shockwaves through global markets. For Japan, a country that imports nearly all of its energy, this was a major blow. Rising oil costs threatened to undermine the fragile recovery and put pressure on businesses and consumers alike. Higher oil costs ripple through the economy, squeezing profits for manufacturers, raising utility bills for families, and making it more expensive to transport goods. Suddenly, the outlook for growth dimmed, and the risks became impossible to ignore. Investors, suddenly wary, began to sell. The rush to lock in gains before things got worse triggered a cascade of selling across the market. The optimism that drove the rally turned to caution, and then to fear. Analysts scrambled to revise their forecasts, and traders watched nervously as prices tumbled. The market's reversal was swift, a reminder of how quickly sentiment can change. In just a few hours, the mood shifted from euphoria to anxiety, and the record high was left behind. The dream of a sustained rally above 60,000 vanished in hours. What seemed like a new chapter for Japanese stocks turned out to be just another volatile episode. The day's drama was a lesson in the fragility of market confidence. Even the strongest rallies can unravel when the underlying support is uncertain. When the foundation of a rally is shaky, the fall can be just as dramatic as the rise. In the world of finance, fortunes can change in an instant, and yesterday's triumph can quickly become today's cautionary tale. Beyond headlines, basic market psychology took over, profit-taking. Investors who rode the rally saw 60,000 as a perfect moment to cash out. When uncertainty rises, even seasoned traders rush to lock in gains. Weakening U.S. stock futures added to the anxiety, signaling possible global trouble ahead. Selling snowballed, triggering more sell orders and amplifying the drop. The market's mood flipped from greed to fear in hours. This is how rallies end, not with a whimper, but with a stampede for the exits. The Nikkei's reversal was as much about emotion as economics. In volatile times, psychology can move markets as much as any headline. The Nikkei's headline masked a deeper divide. While a few tech giants soared, 75% of Tokyo-listed stocks actually fell that day. The rally was narrow, driven by a handful of large-cap AI and semiconductor firms. Most traditional sectors, manufacturing, retail, banking, were left behind. This created a tale of two markets, a booming tech elite and a struggling majority. Such concentration makes the market fragile. If tech stumbles, the whole index can tumble. For most Japanese workers, the record high felt distant from daily reality. The Nikkei's surge was historic, but prosperity wasn't shared. To measure this divide, analysts use the NT ratio, the Nikkei divided by the broader Topix index. On the record day, the NT ratio hit an all-time high, confirming the rally's narrowness. A high NT ratio is a warning. Gains are concentrated in a few superstar stocks, not spread across the market. This makes the market vulnerable if those leaders falter. For investors, the NT ratio is both a temptation and a caution sign. It suggests the rest of the market may be undervalued, or that a correction could be coming. The NT ratio told the real story, a market of haves and have-nots. The imbalance was stark and risky. The Nikkei's brief leap above 60,000 is more than a headline. It's a snapshot of Japan's economic crossroads. Japan's tech leadership is real, promising growth and global relevance. But the benefits are uneven, leaving many workers and sectors behind. Rising inequality and cost of living can breed frustration, even as markets soar. For investors, the day's volatility is a lesson in diversification and caution. Chasing hot stocks can bring big gains, or sudden losses. Japan's challenge is to spread the tech boom's benefits more widely, and build a resilient, inclusive economy. For everyone else, the only certainty in today's markets is change.